There are numerous stories of people with good jobs and diligent saving habits who need to work well into their retirement years. This is not to mention the people who will never have the opportunity for higher education or a stable career. Welcome to the Financial Flow. Please like and subscribe to our channel and turn on notifications to stay up on our latest videos. According to recent reports, less than 30% of American workers are on track to retire at all. And even fewer believe that they will have a comfortable retirement, and they may be correct. There are a few major factors at work in the world today that will act to keep the majority of younger generations in the labor force, indefinitely. This is all before we consider the major stumbling block that the COVID-19 pandemic has been. There are numerous issues going on right now. Housing, the stock market, and a variety of broader economic conditions may jeopardize our general assumptions about indefinite growth. So it's time to learn how money works, and obviously, the first culprit is housing. Affording a home has become a major challenge for most workers in the USA. I know this isn't a new issue, but there are still a few critical factors that people overlook. Even very high income earners who graduate from top universities and work in fields such as banking or big tech tend to relocate to similarly high cost of living areas such as New York, Chicago, or San Francisco. According to Pew Research, the majority of young adults between the ages of 18 and 30 are now living at home with their parents. In 2019, the median age for a first-time homebuyer was 34, and experts agree it's almost unavoidable. The pandemic will raise that figure even higher. What's more is that young buyers tend to be purchasing smaller dwellings like apartments and townhouses rather than traditional freestanding family homes. Not because they don't want to, but because they can't afford it. This is a real issue because, as most financially secure people will tell you, their house is their biggest asset. Owning a home eliminates the need for rental expenses, and even if you are paying a mortgage, those payments will be used to build equity in the home. Furthermore, once the mortgage is paid off, you will have a place to live with very low ongoing costs. When you retire with a home, even modest retirement savings or a pension can go a long way, compared to someone who will have to stretch those payments to cover rent. If a homeowner is running low on cash in retirement, it could be as simple as downsizing their family home. Now again, the unaffordable housing issue is a debate as old as modern capitalism, but maybe this isn't an issue anyway. Maybe you are still unconcerned because you have plans to fund your retirement. Even fixed income pension funds rely on the growth of these markets to provide retirement income to their members. But this assumption of infinite returns may be under threat. Companies raise money and then use that money to purchase capital equipment, which will allow their workers to produce goods and services effectively and efficiently for the economy. You will eventually require a nearly fully automated production line, and even then, at least one worker will be required to supervise an operation. Every human being removed from the equation and replaced by a piece of capital becomes increasingly expensive, especially when compared to other alternative investments. Assume that 5 people will need to invest millions of dollars in a prosthetic arm in order to effectively retire while still meeting their job quota. The person may simply retire and hire 3 random people to work for the factory, while the person relaxes after retirement. This investment into non-productive assets is a major hurdle. Now, real estate is weird because unlike these other non-productive assets, it does produce income without needing to be sold. It does through rent. Investing in real estate has been an especially appealing investment for many people, which does 2 things. It raises the price of real estate and detracts from investments in productive assets that can sustainably fund retirements. Aside from that, there is one other issue: the overinflation of all asset markets. Chainsaws are a perfect example of something that can be associated with these. They were machines that cut up pieces of wood. An average person can chop 20 pieces of wood per day. Let's replace those chainsaws with shares, which are essentially money-making machines that pay out dividends. Assume that each share earns $20 per day. When these assets become more expensive, problems arise in an unexpected way. Most people think stocks getting more expensive is a good thing, and it is for people that already own them. Imagine each share was trading for $10,000. Saving up $90,000 is a tall order for a lumberjack on $180 per day, but it is certainly possible over a working career. If you already own these shares, you'd be happy because your on-paper net worth has increased significantly, But our lumberjack now needs to buy $900,000 worth of shares to fund his retirement, which is simply not realistically possible during his working career. To demonstrate this, consider the S&P 500's price to earnings ratio. Historically, it has hovered around a multiple of 15, implying that the earnings on these shares would take 15 years on average to pay for the share itself. Today, in layman's terms, this means that people will need to invest 3 times as much to find their retirement or sell their shares in retirement for a few times, which is what one investor is already doing with some stocks. You could agree that stocks aren't like table saws with fixed outputs. These dividends can and will most likely rise in the future, and while that is almost certain, it is still unlikely that we will ever see widespread PE ratios of less than 20, again for 2 reasons. The first reason is if that a company starts paying out a consistently high dividend relative to its market price, investors will buy it, pushing up the price, making it no longer a good deal. The second reason is a little more complicated, but it has some leading economists worried. Economic growth was more of an exception than the rule that we should expect to continue endlessly into the future. You do the math. Infinite growth in a finite world. If this rather bleak outlook wasn't enough, that this would coincide with the 6 economic headwinds. These are forces that will act to slow growth in economies around the world for at least the next 100 years. These headwinds are the loss of the demographic dividend. Basically, the economy saw a huge boost when women started to move into the workforce between the 1960s and the 1990s. Now, most women in developed countries work a professional career like their male counterparts, but that's just the status quo now. We aren't ever going to be able to double the workforce again unless we make people work later and later in their lives. The second headwind is the loss in educational attainment, particularly in the USA. Education is becoming more expensive, less comprehensive, and increasingly irrelevant to the requirements of the modern workforce. A 3-year degree simply does not mean as much as it did 50 years ago, not to an individual or to the economy. Researchers were surprisingly pragmatic about this approach to the issue. Researchers noted that incomes were on average increasing by around 1.3% per year, not even enough to keep up with inflation. That means that if this trend continues, it will be inevitable that larger and larger pools of workers simply won't have the financial means to save for retirement. The fourth headwind is the impact of globalization. In theory, globalization should make everyone wealthier, and on average it does. However, averages have outliers, and in this case, those outliers will be the national workforces that have historically enjoyed high incomes relative to the rest of the world. The other side of this equation is that it should equalize global wages, which is great for people in countries with low incomes in comparison to the global average. Energy and environment are the fifth headwinds. The past century's growth was fueled by fossil fuels, a cheap, easily transportable, incredibly efficient source of energy that could power everything from automobiles to jetliners. But of course, they are a finite resource that have come at a cost. This cost will now be paid by younger generations, either in the form of environmental regulations that slow down industrial output, or from complete environmental collapse that will also slow down production. The final headwind is debt. It's all been growing steadily over the years, and eventually this needs to be paid back. This is ultimately going to result in the requirement for more income or less spending. For the government, producing more income is easy. They just tax more. But for individuals and businesses, the only option they might have is spending less. If someone is already on a tight budget, those regular contributions to a retirement account may be the first thing to go. A researcher did present a potential solution to the sixth issue for all parties, and you are aware of it. You might be able to solve it. If all of this has been a bit depressing for you and you will still believe you can make millions overnight, then good for you. I will have to work harder at crushing your spirit the next time. Thanks for watching. Don't forget to leave a like and subscribe to our channel for more content like this. Have a good one.